Hi, good evening, everyone. So, welcome back to our class, Plan 258. So, today is our last class. We're supposed to have a presentation today, but some of you said we want to have either in May 23, no class with only presentation, or you simply send your 3 video reels in Moodle and then make it available for all. So, what is your decision?
May 23 submission, sir.
You will present or you?
No presentation, just
Okay.
submit.
Oh, just submit. Okay. In that case, the third one. Right. Okay. So in that case, we can have today we continue with financial economic analysis and sensitivity and elasticity, and hopefully, if we have time, we can continue with the given points. And I'm not sure about the time size. Okay. Good. Okay, so let me share with you the screen. I'll share the second screen. Okay, so I will just close this one. Okay. So if you go to our Moodle course, change these entries. Okay. So the presentation and video reel and internal report, all about 22 or 23 March, so next week. Okay. And yeah, so if you go to Google and type sensitivity analysis in Revolution, I think the first it will go to that page. Yeah. So this is a tutorial on feasibility study, how we use the financial and economic evaluation, and the Excel worksheet you can download here, and the text will explain the problem. So this was part of my consultation when I was in Japan, I guess. Yeah. So, but I put it in US dollar so that the value will be easy to understand by others. Okay. And these are the data that we have. So we want to introduce a new bus system for elderly people. Okay. And we did this survey from the bus company and also from the potential user. And then there are certain rules from the LGU. The maximum fare should be a certain value. Okay. And then we try to evaluate, okay, the two investment, yeah, either using minifund or using minibus. Okay. And these are the data that you can see. And then these are the problems that we want to check. Okay. And from there, you can start to see we can compute NPV, VCR, and IRR that I introduced last meeting. Okay, and then the most important part there is actually how we define the cost, and then the benefit. Okay, so the costs include the purchasing cost, operation cost, maintenance, and administrative, and then the benefit come from the income. Okay? So then we start to model. Okay, this is the name of variables, and eventually we start to model for its variables here. Yeah? So the cost we need to calculate based on the gasoline, the engine, and oil, and the tire, and then the cost of driver, and so on. And then we need to discount, okay, over years. So similarly with the benefit, okay, we have the daily benefit based on the fare, and then again we need to discount it over years. Yeah. So again, the another variables is the bus operation. So we need to include everything, all the operation, including the possible load factor, distance, and so on. Okay, and from there, these are the diagrams, okay, to compute the total cost and total benefits. Yeah. So this yellow part is the constant, and this orange part is the target. And these are the formula that I showed a while ago. Okay. Based on that, we can compute the Excel in Excel, yeah, the computation. Yeah. So this is one of the scenario. So you can also use scenario analysis in Excel. You know, this is the old system. You go to what if analysis, the tools, scenario, and then you add, and then you can add any scenario. Okay, so you can have several scenario, and then have several variable as well. Okay, with this you can set up, for example, this is the load factor scenario. So you put one by one, and finally you click summary. Okay, check what is the result to show. For example, this one is NPV, PCR, and IRR. And then after that, you can get this kind of table. To Excel will generate this table automatically for you. So with this, you can see these are the variables, and these are the different alternative, right? Minifund and minibus. And this is the result, yeah. NPV, PCR, IRR. Okay. And of course, from that, you can also find the optimal value based on call sheet if you want. In terms of financial analysis, these are the online calculator, yeah, and of course the explanation about that. So if you have the money now, down mean you pay, okay, up mean you receive, okay, and these are the formula. Yeah? If you know the present value, you can get the equivalent present value in the future. Okay, and K here is the interest rate, and N is the number of years. Yeah? Of course, once you know this formula, okay, can you see it well? I'll make it bigger. Okay, so once you have this value, okay, so you can put, if you know the future and interest rate and the years, you can get the present value. Yeah. Once you have this, because they have four variables now: future value, present value, interest rate, and time. Okay, so this is the formula to connect the four variables. The time, interest rate, present, and future. And then, of course, once you have three of them, you can get the four variables. Okay. So, for example, here, if you know the future value and the present value, okay, and the time, then you can calculate the interest rate. This is useful to get, for example, inflation, interest rate, or the growth factor. Yeah. Similarly, if you know the future and present time and the interest rate, you can get also the time. Yeah. So aside from these four, you also have payment. Annuity means you pay either yearly or monthly. Okay. So then we can also connect regular payment. Okay. For example, you receive loan here in the year 0, and then in the year 1, you start to pay annuity, yeah, until in N. Okay, so this is the formula. Okay, in Excel is equal to PMT. This is the function of PMT. So similarly, you can also have pay first. For example, you pay insurance. Okay, every year or every month you pay regularly, and then this is the amount of money that you will receive in the future. So if you have regular payment and or this is the loan, this is the one that you pay, or you pay first and then you will receive at the end. Yeah, this is the formula of this one. Yeah. So for the projects, so you can choose the appropriate formulas. Yeah. So this is the given 1, 2, 3, and then this is the last variable that you want to find. And then this is the formula, and this is the Excel function that you can use. Yeah. So anything that involves a future formula, so this is future value, FV, okay, based on the interest and the year, and P, here is the present value. Okay. This one you need to put 0 because this represents the payment. So if you are talking about the payment, so A here, the third parameter. Now if you want to get the payment itself, okay, if you want to get the annuity, so then you use the formula PMT in Excel. Okay, so all of these Excel function will give you negative value. Okay, so if you want to get a positive value, then you put minus in front. So if you don't like to use Excel, and I also provide online calculator here. Okay, so you just compute it here. Okay, so these are the all possible computation. Yeah, given this, and you can get all. Okay, with that, I hope the basic of financial analysis, you know. Is there any question? Did I share those? Yes. Okay, so how did I get the formula to get the year? Okay, so this is the original formula of future value equal to present, and then K is the interest, and N is the number of years. Okay, so if you want to get the number of years, then you need to take the log both sides, and then you just do algebra to get this simplification, yeah, of the formula. Yeah. Similarly, you can get the interest rate, yeah, based on this formula. Yeah. There is possibility, depending on whether this is. So if you want to get the interest rate based on the loan, you can also use exponent. So I give you assignment to compute, okay, your own retirement. Okay, this is an example of retirement calculation. Okay, so if you have, for example, how many years your age right now, and then how many years you can save, okay, monthly, how much, for example. This is example, I can put numbers here, 5,000 pesos, for example. And then you invest in certain stock and bond. Okay? You can search that many stocks actually beyond this number, yeah, beyond this 10% per year. Okay? So then you can check, okay, instead of you put money in the insurance, you can put set up your own insurance within you, if you are disciplined enough to do so. Yeah. Then you're supposed to get how much total saving that you can withdraw per month after you retire. And then the question is how many years can your retirement sustain? Okay. And what else? Okay. So aside from that, okay, you can also use the same technique of analysis. Okay. This is an example of the Excel file a while ago. And for the bus. So if you download from Level, these are the scenario analysis, this is the conversion table with the summary, and this is the computation for the bus analysis. Yeah. And I can show you also two more example, but I cannot share with you. I just will show you here. So these are other example. Okay. What happen if you say, for example, you buy a condo unit, yeah, in Manila, okay, and then say you rent it out, how much, yeah, and then you pay certain utility, yeah, and these are assumption of inflation rate, and then say after 10 years, then you will sell that unit, yeah. So then this is your buying cost, and then this is the income that you earn by renting it out. Okay. Question is, how much is your NPV and ROI, yeah, and IRR and so on. Okay, so you can check by yourself. Yeah. I also give you the template for this one to compute the multi-years analysis in a cycle. That means cycle means every certain years, for example, 10 years, you repeat the same cycle. Yeah. So for condo, I think if you look at the money here, okay, you actually earn back when you sell, yeah, not when you operate. Okay, because the price of the condo unit is too high already. So practically the contractor or the developer earn your benefit rather than you are the one who buy that condo unit. Okay. So the IRR is very low. Okay. It is lower than actual loan. And we compare this with taxi, yeah, like Uber or Grab. So say you own one taxi unit only, and then you buy one taxi unit. This is about the price, and then you need to pay the government for the registration, and this is the maintenance for months. A boundary means the income from the driver. Okay, assume certain number of operation, and these are the tax. Yeah, pretty high tax in the Philippines. Yeah, and every year also you need to pay again license, okay, for the government. Assume certain inflation rate, and because this is taxi, so the salvage value is rather low. So assume that 20%, 10%, and you see that the IRR is very high. Okay. Assuming again the same assumption, yeah, every 10 years you will sell. Okay, then actually about 2 years you will get PEP already. Okay? So this is very good business to operate. Yeah. So is there any question? Is it clear enough? Based on the analysis, yeah, of financial, okay, so you can start to compute all of these investment possibilities, yeah, including invest to yourself, yeah. in your retirement, for example.
Doc Hardy, question.
Yes.
Regarding the assignment regarding the retirement, is it okay to provide, inputs like the instead of 5,000,
Oh yeah,
I like, yeah, yeah, it's okay. Because that is I think we
the main
can,
concept. So
yeah.
you can change any input number. These are
All right.
the number I put there is just an example of input that you can put.
Okay, all right, okay.
But you change it according to your own need. Is it possible? Okay. So if you have any assumption for your own retirement, just change it. Okay.
All right, sir. Thank you very much.
Right. Okay. Is there any other concern? Yes, Vin.
Sir, can I ask something about the example on economic analysis, the bus system?
Yes, sure. You want to share your screen or I will share my screen?
I'm
Okay.
sharing my screen, sir.
Okay, go.
Okay, I followed what was in the slide, sir.
Right.
Okay, and then this one I'm not sure of.
Yeah.
I think this IRR.
Correct. The IRR is probably not really correct in that case because you need to, if you want to calculate the IRR, you need to create the list of table. Okay, every year you need to add. Okay,
One.
Yes, the IRR is not, yes. So you need to get the year and then the benefit and the cost. Okay, and then you put it all every year. Okay. And then you get the net with this benefit minus the cost. And then that is the one that you need to compute for the IRR. Can you go to the template of investment in Revoledo?
Template.
Yes. I give you the template of investment analysis in Revoledo. Okay. I think, can you get that?
Yeah, this one, sir.
Yeah, I guess. This is the old one. Can you download the new one?
Not the new one.
Yes. Yeah, you refresh the browser and then you download the new one. Okay. Oh yeah, I forgot the last meeting we discussed the queuing, right? So I updated the examples there. Franz, I think you asked about the update, right? So I updated the example there, and I found out one of the example is I got mistake, so I replaced with the correct one. Okay. So please update your slide as well. Yeah. I have also the computation of elevator. I think the incorrect one was not the elevator, but the intersection. Okay.
So I downloaded the template. It's the same with earlier. I think it's not yet updated. If you updated the template investment
Okay,
analysis.
let me show you the template that I have recently. Is it the same as this one?
Yes, sir.
Okay, so this is the updated one. So the point is wait, so you need to create something like this, right? The benefit and the cost, and then you get the net, it is the benefit minus the cost. Can you see that? Oh, what happened to this? Okay, I need to enable editing. Okay, so benefit minus the cost, right? And then this one is PV. So,
Then get the present value.
right. So the IRR, you need to get it from here. Because if you get the IRR from the last one, for example, this one, this will become a double discounting.
Hmm.
Right, so you don't use from here, but you use it from the initial. And then while the PCR is simply you get this, but the benefit you get it from this value, this column, after you discount it. The same thing with the cost. The cost you get it after you discount it. The reason I put this separate, because we have to put this inside. You see, there. Because at the beginning of, or the end of year 9 or the beginning of year 10, so we need to sell, right? So this is a cycle, one cycle. This is every 10 years. Of course, if you don't like this, you can just change on your own. So the benefit I got this from, so until here only, not until the bottom. The same thing with the cost. This one until this part. So you can change this value like in yellow, even though this is informal. So, did you get the same Excel sheet?
Yes, sir.
Yes. Okay, so if you are not doing cycle, this is the assumption is a cycle. So this you can read by yourself. These are the assumption. So if you are not doing cycle, so you can just put until here. So you can delete this part. Okay. So the same form you can use for any investment, including project evaluation and so on. Right? So the one in the bus use economic analysis. You're supposed to create something like this for each scenario of the bus or mini fund there. I guess this is what you asked, Finn.
Sir.
Correct?
Yes, sir. So I get it that I need to do the
The
analysis
details.
first before getting the IRR.
Right.
I thought I can do it with just the negative
No.
of the cost and the total
That
value.
was not really correct.
Yeah.
Example.
So you need the whole cash flow.
Yes. Because the formula in Excel to compute the IRR is actually search for the whole cash flow. You put it in and then and this one must be year. So Excel assume this is year 0, year 1 up to year 9. That's why we cannot add until, for example, if I put year 9 and then I put here again 9, for example, 9 and 9, it will become incorrect. Okay, because Excel assume this is year 10 already, but it is actually not.
Okay, sir. We'll try that on the economic and on the bus system example, and I'll ask it.
The result will be different.
Yes, sir. It should be the same as on the slides.
Should be the same as this one.
Yes, sir.
Okay. Yeah, thank you.
Thank you, sir.
Any other question regarding the financial economic analysis? It's rather simple actually, right? Oh, okay. So if you are in the field, right? Say you have only calculator, not the scientific calculator. So you have only a simple calculator. So then this is like the rule of thumb. So this is called rule 72, right? it's just very well known so that you can compute simple. Okay, it just states that the number of years required for the money to double. So this is called doubling time. At certain interest rate K is equal to 72 divided by the interest rate. Yeah. So using simple calculator or using your own mind without a scientific calculator, you can do this. Yeah. For example, yeah, if your money 6%, it will double about 12 years. So 72 divided by 6. So you remove the percentage. So fairly good result, yeah, for a wide range of interest rate. Yeah. Let us see. So this is supposed to be the period, isn't it? Right? The formula for the computing the period. This is the accurate one. Yeah, using scientific calculator, you can calculate this. Okay, and if you compare that with Rule 72, okay, so let's compare interest rate from 1% to 35%. Yeah. The question is, at what interest rate the Rule 72 actually keep more than 0.5 absolute error? So I create this Excel sheet and then compute it. And K is the interest rate, right? Then here is the absolute error. Yeah, if the value interest rate is about 8%, this is about the best one. Yeah, 6 to 8%. Above this is pretty okay. You see the absolute error is pretty small. Okay, but when K is small, actually the error is very big. And when K is 1, 2, 3%, 4%, this is actually a very big error. Yeah, so be careful when you are using the Rule 72. Okay. Next term is about effective and nominal interest rate. Okay. So sometimes the bank or financial institution, they will put simplified version. Yeah, for example, they will say nominal interest. Yeah, the jargon is nominal interest. So 3% compound each quarter. So the bank will say something like this. Yeah, 3% compound each quarter. They will say 3% times 4, which is 12%. Okay. The actual interest rate is not this one. Yeah, the actual interest rate they will put effective interest. Yeah, so you still need to compute using this formula. So if you have 3% quarterly, so then that 12% you divide by 4, exponent 4, because quarterly, right? So if you said 1% compound each month, that the bank will say 1% times 12, it is 12%, yeah, the nominal interest. So be careful, the way they compute is actually effective interest. So 1 plus this is 12%, right? Divided by monthly, so 12 divided by 12 months, and then exponent of 12 minus 1. And this is the actual interest rate. Yeah. The bank probably will prefer this value, but the money lender will say this value actually, yeah, because this is a little bit slightly higher. Okay. What else? I think those are the most important part of the financial analysis, you know. Any other question on financial analysis?
Sir, is it possible to analyze investments like for volatile investments like stock market or like Bitcoin? So since Bitcoin is rather up and down, is there a way that you can
The same formula you can use. Okay. But you need to use time series if you want to do that.
time series?
Yes. Check in Moodle. I have down there
Mhm.
That is a time series analysis.
Okay. Okay.
Okay. Yeah.
Yes.
Not
Thank
sure we have time to discuss, but that's much more complex than so you can use that if you want. Okay, I will later brief you if you want. Okay. Okay, let me find that slide. Time series analysis. So that we don't need to wait until later. Time series. Put it in the statistics. Okay. So can you see my slide?
Yes, sir.
So there are many ways to do time series. Okay, so analysis. So if you have forecasting, yeah, so demand, cash flow, cost, economic analysis. Okay, so all of this you can forecast, okay, based on time series. Of course, there are assumption on that. Yeah, okay, many assumptions that you put. So certain assumption is called trend, cycle, seasonal, and irregularity. Okay? So you assume certain trend may happen, you assume certain cycle may happen, or seasonal or irregularity. So seasonal means small cycles. Yeah, the cycle itself is a big cycle. So and then you add all of this or you multiply all of this, okay, into one. And then there are certain random values. So we call this irregular. Yeah? But the data is recorded at regular interval. So, okay, so application many. Yeah. So let's start with simple way if you want. So let's do this in Excel. Okay. Let's start with any Excel values. I will just close this one and let's create new one. Okay. So before analysis, I want you to generate. Is that okay? So let's say you have time here. Okay. And then you have your set price. Okay. So let's put 0. So the time, the data is get at regular interval. So I will put +1. Right. And initially you have, say, 100. Okay. So this is data. So data, right? So let's generate. Let's generate the time series data. Yeah, let's generate the time series data. So how we generate time series data? So you will say previous value, okay, plus normal distribution. Say we assume normal distribution. Or which one you will use? Say the normal distribution inverse. Okay, and then this normal distribution inverse supposed to have probability, mean, and standard deviation. Yeah. So let's say the random value in terms of probability. Okay. And then the mean, you can put any number. So in I can put 1 and 0. Oh, sorry, 0 and 1. Yeah. So that it become Brownian motion. Yeah? So I got this value. Then what we will do is I copy this and I make it, say, up to 50. There. And then now we plot this. Yeah. So we can plot this one. There. Okay. So you get the time series data, right? And this time series data, you can actually regenerate. Mm. In the formula you calculate now, you will create new data. Right. Okay. Now come back to time series analysis. Where is my mouse? Okay, there. Okay. So there are many methods to forecast. Okay. Of course, you can use Delphi method, expert opinion, and so on. So I will just skip this. But you can start to forecast based on quantitative model. Okay. So then you need to distinguish whether you have trend or cycle, season, and random. Yeah. Trend means increase or decrease. Yeah. So the way you increase or decrease is basically either linear or polynomial. The simplest is linear. That means you have a straight line. Okay. Polynomial, you can have a curve. Polynomial quadratic or cubic, and so on. Okay. So these are representing the trend. Second is the cycle. Yeah, cyclic. This is a large-scale movement with unspecified periodicity. So the period is not clear. Okay, but there is some kind of movement. Usually we use sine, for example. Yeah. And then this is called seasonal, is the regular pattern. Yeah. Every December, okay, in the Philippines, probably there's a large trend. Okay, people will buy certain things. Okay, so the pattern is repeated over certain regular interval. Okay, and then of course there is some random noise inherent in the system. Okay, then there are many ways to forecast. Okay, in the short term, usually you want to check only the random variation. Okay, so the simplest way to compute in the short term is either use a naive random walk or MA, yeah, moving average, or EMMA. Yeah. EMMA is exponential moving average. This is also called exponential smoothing. So if you have random term, you want to check the random variation. Yeah, you remove this random variation, then this is the best way. Okay, but if you want to get a trend, the seasonal, cyclic, and random, okay, then you use regression, yeah, or winner process or decomposition. Yeah, but if you want to calculate 100 years, okay, like for example the CO2, yeah, then you don't need this random variation, yeah, because the time itself will remove all of this. So you maybe only focus on the trend and the cycle, yeah, not seasonal. Okay, so in this slide, mostly I discuss about short term, yeah, how we will remove, okay, the random variation. Okay, so yeah, this is, you can practice. A while ago, this is the one I just showed. Yeah, I use a normal distribution of 0 and 1. That means the mean is 0, the standard deviation is 1. So this is called random walk, or with white noise, or sometimes called Brownian motion. Okay. So using this naive random walk, so you can check. Yeah. This is the time series data that you have. Now, if you get only a certain value, okay, with this, for example, x100, yeah, or x50, yeah, meaning the price at the day of 50, and then you generate many times, okay, price of 50, and then you make into bar chart something. Eventually you will get the distribution, okay, so which is equal to the assumption that you put in. This is the most important part. Okay, even though one generation, okay, is different from the next generation, okay, but if you just put one value of this 1 point here, and then say at 50, and then you generate many times, and then you find the distribution, yeah, you will get exactly what you assume. So in that case, we can, if we can get the distribution of this, then we can get the assumption behind. Do you understand the logic? Say, you can actually, from the data, you can find the distribution. That's the main point. So if you know the distribution, then you can generate. Okay. So how you predict? So say, if a while ago I generate using normal, then you will get normal distribution. If you generate using Poisson distribution, it will create Poisson distribution. Yeah. If you generate using, for example, log normal, say I check, for example, Japanese yen to US dollar or Bitcoin, for example. Yeah? So you will see that distribution is practically log normal. Okay? Not normal, log normal. Then you can start to generate based on that. Okay, or you can start to compute using based on that distribution. So let's say you are using normal distribution. Okay, okay. So if you know this year demand is say 100, okay, and you know that distribution is normal, so then you can calculate what is the general formula to get next year, next 2 years, or 3 year. Okay, because this is normal, so you can compute. Okay? So x1 is x0 plus n01. Okay, this one is the first year. The next year, the next 2 years, okay, that means x2, okay, that you get this value. So you will get n 100 comma square root of 2. Okay? So in general, okay, assuming they are independent normal distribution, okay, then you will get this formula. Okay, so xt will be the normal distribution based on x0, which is the first one, say 100 a while ago, and then this is the standard deviation over t. So that means the longer you predict, the boundary will be around square root of t. Do you get that idea or not? Shall I draw? The meaning of this is, say this is your current value, okay, and this is time. Okay, that means over time you will get something like this. Okay, so prediction, you don't really know the actual value, you will know the boundary only. It will not go beyond this boundary. That's the meaning of prediction there. Okay, so if you use random walk, this is the result. So how about if you use other way? Yeah. So other way is called smoothing. Yeah. So one way to do is called moving average. Okay, let's come back to our Excel. Yeah, moving average is simple. So if you have this sequence, for example, this is the value, okay, and you use moving average of 10, okay, then you can calculate. So not sorry, moving up, m is 4, for example. This is the formula. Then you can calculate divided by 4. Yeah? So every 4 okay, you get the average. So every 4 you get average, and then you put that into the new one. So moving average again, you have depends on the position. So where you will put, if in the beginning or in the end, usually in the end or in the center, yeah, something like this. So if you moving average of center, this is the formula. Okay, so in this case, the same data, you will get different value. Okay, so let's do this moving average, okay, in our related time series oil. Okay, so to check this, say you have this one, right? So now I will have MA. So in MA have one parameter. So for example, I want to do MA5. Yeah? That means 1, 2, 3, 4, 5. Okay. So what I will do is I get the average. Yeah? Average of the previous 5. Isn't it correct? 1, 2, 3, 4, 5. Yeah. So this is called MA, moving average. Okay. And then what we will do? We will just copy this, okay, and then put it here, right? There. And then we plot again, yeah, we do the same thing. So we add the design chart, we select the data, so we add new one. So this is called MA 5. The X is the same, right? X is still the same. And then the Y, now you use the moving average. Okay. Click OK. Click OK again. There. Yeah. So I will show you the legend so that you will know which one which. Yeah. So this is the MA5. So the MA, yeah, the moving average always have missing data here in the beginning, right? And what the MA does, okay, the MA is doing smoothing, okay? The higher your MA, it will do smoothing more. Is it clear or not?
MA is used for prediction, sir, right?
Yeah.
I see it in the stock and Bitcoin moving averages 200, 100. Yeah.
So because this is short term, so your prediction is only one after. Yeah. So say you want to predict here, okay, say 48 here. So then you just copy down, right? So this will become your prediction.
Moving, trending, increasing. Yeah.
Yes. So based on this, so you cannot predict beyond this one, and because you will assume, because you don't know the data, right? So
Yeah.
you can only predict up to 4 or 5, right? Depending on your moving average.
Moving averages.
This one you cannot predict anymore, the last one, because you don't have data anymore. See? So eventually you will get like a straight line. Okay. In the slide there. Yeah, so you create this one. So if you plot, you will get this value. Okay. The higher order MA, so the number here, then you will get smoother. Yeah. the way we do is in the stock market, we find the crossing, yeah, crossing between the MA and this price data. Okay, because if you look at this value, okay, when the price going down, okay, then the MA will also go down slowly. Okay, and if you put here across the next crossing, that means the price will go up. Okay? Again, the price will go down here. But sometimes, if you put the MA very small, okay, the number of crossing become a lot, then become noisy. Yeah, noisy signal, we call it. Yeah. So then people say maybe we need to define it not just one crossing, but two crossing. Then they create what is called MACD, for example, yeah? MACD. Yeah. So forecasting is just continue of that. Right? So we just continue on that. This one is the way to forecast. Okay. And then if you, this is using center, so you will get something like this. Not so nice. Okay. So next way is called EMA, or weighted average. You can do that. Yeah. Okay. So you put different values in the weight. Yeah. Instead of moving average 3, you assume the same weight, right? But you probably want to put the latest one have higher weight than the old one. So then you can search for what is the actual weight based on the previous data. Yeah. So you can assume. Of course, you need to put this random value into numbers first, yeah, before you do this. Okay. And then, yeah, I think we discussed about time average, yeah, last time, right? So, based on that, like, time average, okay, we can get what is called exponential smoothing. Yeah. This is the formula of exponential smoothing. So this is alpha is the learning factor or the smoothing factor. Yeah. From here, we get what is called EMA, exponential moving average. So this is the actual formula of EMA. Okay. So based on this, you can again use, yeah. You can optimize the alpha. Again, if you want to optimize, this should not become a random number, yeah. So this is supposed to be data, not random. Yeah. Because this is an example, so I put this. Once you get the minimum, you get the alpha, then you can forecast. Again, the forecast of MI, you just continue. Okay. Once you calculate, you can just continue on that. Okay. So another way is to do for medium term, say, you can use winner process. Yeah, this is for medium. Instead of just smoothing means you want to smooth the random values. Okay. So now you start to assume certain trend. Yeah, that's why we have a medium term here. So for the small, these are the assumption. We use normal distribution again, like random walk a while ago. Yeah. But now we have some kind of volatility. Yeah. So there is a drift rate here. Can you see this value? Alpha times T. This is representing the trend. Yeah. So now the delta, the change, representing not just normal distribution, but you have certain trend. Yeah. Then if you compute this, okay, using integral, so this is called Ito process or Ito integral, then you will have this normal distribution, okay, of alpha and sigma. Yeah, sigma is the standard deviation. Alpha is the one that you set as drift rate. So again, you can compute this if you want. So this is the example I put in Excel. Yeah. So say you put alpha and sigma here, then you can set winner process. Okay. I will compare this with random walk a while ago. Okay. Then the result will be this one. Yeah. The winner process compared to random. These are the random values. The yellow one is the random walk, and the pink one is the winner process. Almost similar to random walk, but a bit smoother. Okay. Based on this, we can also predict. Okay? So if you know the average trend, so this one is 10,000 customer, and you know the standard deviation, and then you know this year, then you can predict next year and next 2 years using winner process, yeah, based on the formula a while ago. Okay, so this is the formula of winner process. So then you can just plug in the numbers. Yeah. If you want to add normal distribution with adding another normal distribution, so you need to remember the formula of additional normal distribution. Yeah, the mean is adding, okay, but the variance, you need to take the square root. Okay. So eventually in the stock market, this is what you often use, isn't it? So so we know the initial value, okay, and then the change over time. Yeah. Then this is actually the drift that you have, and then this is the standard deviation of volatility. Yeah. Now, based on this, you can integrate, and then you can get the additional. And you see that distribution is actually log normal. Yeah. You can try by yourself, okay, get your real world data, and then you search the distribution of that. I think it's very close to log normal. You can use goodness of it, yeah. Either a KS or using chi-square if you want. But that's supposed to be in statistics, not in this case. So this is an example. Yeah? If you have the volatility of certain value and expected return certain value, and this is your current stocks, so then you can calculate how much is the expected price change in the next 3 months. So then you can use that formula, okay, to get the expected value. Again, if you look at this and something like this means you only know the boundary. Yeah? You don't know the actual price, but you know the actual boundary. Do you understand the meaning of boundary? Maybe I will show you with example so that you can see. Okay, so I think I have in calculator. Well, let me find the tutorial. That. Oh, this one, recursive average. Okay, and then recursive variance. I have this one. Okay, so that you will see the rate. Okay, I will do random input here. You can see this. This is exactly what happened. So you can predict, okay, and these are the boundary. Okay, So for example, this is now your input. Okay. And then it will become closer and closer. You see the boundary is getting smaller, like this. But if your result is random, so again, the boundary is getting bigger again. Do you understand the meaning of the boundary? So when you predict using winner process a while ago, okay, what you get is not the actual value. What you get is actually the mean and standard deviation. You see here, this is the mean and this is the standard deviation. So that exactly the trend and where is the location. The value will be about that result. Okay, now the next example in the slide of time series is what if you can have all of this data? Okay, you can assume all the trend, cyclic, seasonal, and random noise. Then you can use this is the simplest method called decomposition. Okay, so again, you can have the trend, the cyclic, seasonal, and random. Okay, so in decomposition, you can have many models. Okay, one of them is additive, the other one is multiplicative. Okay, so the simple guide for this one is you look for the period of seasonality by looking at the pattern in the data. Okay, and then you use MA or moving average or EMA a while ago, okay, to offer the period of the season and then take the centering data to produce the MA series. Yeah, if the number of data is given. Okay, so the MA series contain no seasonality or random component. So I hope you understand. Once you understand the MA, the purpose of MA is actually removing this random component and seasonality component. And then you divide the time series with the moving average of the time series to produce the seasonality. Okay? So in this case, we have seasonality series, seasonality and random. So I will put this name SR, means seasonality and random. I. This contain only random and seasonality only. Okay. Then from there you can you take the average over all the SR, the seasonality and random, okay, so that it will occur on the same seasonal position. Remember, seasonal means exact period is known. Okay. After that, you perform regression, yeah, to get the trend on MA data. Get the trend. Okay. Once you get that, okay, once you get the trend, okay, then divide this trend into the MA series to get the estimate of the cycle. Okay, and then you can get finally the randomness component. Do you understand the meaning of this guide or not? You remove one by one, okay, and then eventually you will get all the components. Once you get all the components, then you can forecast. Okay, so to forecast, you forecast one by one also. Okay, so you forecast the seasonality, which is simply continue the forecast period. You can forecast the trend based on that regression trend that you have. You can analyze the randomness, okay, by getting the distribution shape. Okay, so you add additional randomness based on normal distribution or log normal distribution and so on. The same thing with cyclic. Yeah. So I give you example so that you can understand this. Okay, so say you generate this time series data. Yeah, this is deliberately we create a kind of seasonal data. Okay, instead of plus, you multiply. Okay. A while ago you plus, right? So in the end, you just create the cyclic seasonal data. Okay, and then of course this is a random component here, at certain value. Okay, and then try to decompose this. Trend, cyclic, seasonal irregularity based on multiplicative, and suppose we know the period is 12 months. Okay, and then you can forecast this. Yeah, you can forecast the seasonal, the cyclic, and then randomness you can just based on normal distribution. Okay, and this is the result. Yeah, this is how you will do it in the Excel spreadsheet. So I put everything here. So if you do it slowly, you're supposed to be able to get. Yeah, this is the data generated. This is the MA. This is the center, and then you see here we get the SR. Yeah, the seasonal and random value based on the guide a while ago. And then this one is to get the slope based on the MA. Yeah. So the slope and the intercept. So we assume linear model. Okay. From there, you get the seasonality, and then you get the trend and the cycle and the randomness. Yeah. So first you decompose first, yeah, into all these components. Once you have this decomposition formula, then you continue with the next slide, which is now you continue with the forecasting. Okay, so first you do this, and then you do the forecasting. So in this forecasting, can you see the difference? Okay, now you the trend is just the same, so you just add in here. Okay, and then all of this you just copy on one line here, and then you just put it down and copy down. Yeah, then you can search the average and standard deviation at the end. Okay, so let's see the result. Yeah, this is nice. Can you see that? So you can see the trend. Okay, and you can see the random variation. You can see the cyclic indices. You can see the seasonality and random. And this is the seasonal indices. And this is the forecasting. Yeah, this is the data, the blue one. And the pink one is forecast. Because you have the cyclic, so the forecast, you have the cyclic and the trend. The forecast is also exactly the same. So this is interesting. You can practice this if you want, yeah, so that you can use this. This is not only for the price. You can use for traffic. You can use for city growth. You can use for any values. Yeah. So if you want to do long-term forecasting, of course, you ignore the random variation and seasonal variation. Yeah? So in this case, you can use trend and cyclic only. So I have a paper a long time ago to predict traffic. You can check in my website in Revolutum. Okay. That one is using whole winter. Yeah. So whole winter have a different way, similar to the composition. Yeah. That one you have a level, and then you have the trend, and then you have certain seasonal. And then you can use either additive or multiplicative. Yeah? So I can use many ways. So you can use, for example, linear model. These are example of linear. Okay? So if you have this formula, once you know the formula, then you can put them into Excel. Okay, these are the Excel example. I generate random data and then use the whole winter linear model, this value. And then you can see the prediction. And these are the error. Okay. I think I should stop here. Otherwise, there are many other methods, yeah, in time series, yeah, including the correlation and whole winter, the next whole winter, and eventually, this ARIMA also another possibility. So these are the summary of whole winter formula. Okay, whether you assume, yeah, whether you have trend or no trend, you have seasonality or not, and what is the seasonality? Is it additive seasonality with constant variance, or you have multiplicative seasonality with varying variance or not? Yeah. So based on the assumption that you have, then the formula changes. Okay. The one that very complex and usually we use is called ARIMA. Yeah. This one have this model with this stochastics. Yeah. Similar to random walk a while ago. Okay. But now we combine the two of them. Yeah. And then you integrate all of this together. Okay. So the ARIMA is rather complex. Okay. Because this is instead of one parameter, you have many parameters. Okay. And then you can also use one of them. Yeah. For example, this is the simplest is AR1. Yeah. The MA is no more. Then you can first you need to find out which model that you use. Okay. Nowadays, I think there are a lot of software you can use to do this ARIMA model. Okay. That is based on autocorrelation and partial autocorrelation function. Yeah. The basic idea is if you have the data, okay, it assumes there is certain correlation, yeah, within the same data. So because this is only one variable, so this is called autocorrelation. Okay, and then this autocorrelation can be put into some kind of regression. So that regression part is called partial autocorrelation. So again, the model is getting much more complex than what I explained a while ago. Yeah. So in that case, I will just stop here. So any question about this? Yeah, you can continue to learn by yourself. Yeah, I will not include the time series in the exam. Just to answer your question a while ago. But if you want to learn about this more detail, so please continue. Okay. Never stop learning. This is the most important part.
Thank you, sir.
Yes. Nowadays, in fact, even ARIMA is already old, so there are many new models coming in. Okay. Actually, there is 5 years program called econometric. So that 5 years or 4 years program bachelor degree is only learning about time series. Isn't it? So that's called econometric. Yeah. So the one that I explained a while ago is just very scratch in the surface. Okay, but at least you know that is. Yeah. So knowing this, please don't just use very simple group model dividing, yeah, in your trend analysis, isn't it? That is a little bit too. At least you use regression. At least you can use decomposition if you want. Okay. Yeah. Last year project, I still see UP students using growth factor, which is just divide. Yeah. Today and yesterday, and yeah, last year and this year you divide, and then you get growth factor, and then you just continue with the constant growth factor. Well, okay, that is like 1940, 1950s. Very simple, but too rough. Again, There are many newer model that you can use. Rather than next one. What was in the agenda a while ago? Sensitivity analysis. Please check the slide in Moodle about sensitivity analysis. Can you see my slide?
Yes, though.
Okay, thank you. Sensitivity analysis and elasticity analysis, both are very important technique in economic and decision making. And especially in transportation, we use this a lot, actually. Okay, so I'll just give you in brief about sensitivity analysis, revenue maximization, and price elasticity. Okay, so this is a technique to help us how small change in the input variables can affect the output. Okay, so we want to check sensitivity of the result, okay, of any scenario that you put, okay, and then if you see, for example, okay, you are assuming certain interest rate, right? Okay, so you're assuming certain variables that you put in your model, okay, then how if the demand change, how if the price change, how if your assumption, the interest rate change, okay, not change so much, but change a little bit, up and down. What is the impact? Will the decision change or not? That is the meaning of sensitivity analysis. So if your model is not sensitive, then it's okay, right? But if your model is sensitive enough, then you need to care about that factor. So that is sensitive. When you want to implement something, you need to care which factor is actually the most sensitive in your model. Okay, knowing which factor is sensitive means small change will produce large output change. Okay, that is called sensitive. Okay, so how much you can increase your product price, for example, without reducing your revenue. Product price in the company, in transportation, is called fare, isn't it? If you want to increase your bus fare or MRT fare or jeepney fare, okay, what is the impact? Will the number of users change or not? Say you want to change the parking fee or gasoline price, what will be the impact? Okay, these are the example of so say you want to change the interest rate, for example, what happen if the interest rate change? Okay, will that profit change or not? In terms of what is the other factor, for example, the revenue and the operating costs and the tax rate and so on. Knowing the values, okay. Which slide is different?
From the start, then the previous slide you presented just now is the same, and this one is
This one is
not-
different.
different. Sure.
Okay, I will update later, no problem.
All right, okay, great. Thank you, sir.
Yeah, this one is different. Okay.
Yes, sir. That's different. Yeah.
This is just example. No? This is just an example. If you want to change, for example, you are an engineer, you want to change the stability of the bridge, or okay, what are the possible factors that you put, and then small change, yeah, small perturbation. Okay, this is the one that you can see, yeah, the meaning of sensitivity analysis, right? So, so what is sensitivity analysis? I think this is the same. Right. So sensitivity analysis formally is just investigation. What is the effect of small change, perturbation, okay, toward your function? Yeah. So say you have this function given, yeah, y is equal function of x. Then what is the effect of delta x toward the delta output? And the delta input toward delta output. That is the meaning of sensitivity analysis. Yeah. So with that, you can compute. Yeah. Simplified version is this example of demand function. Yeah. So y in here is demand of certain product. X is the price. For example, price of banana. Okay. So we want to know you have the demand function of banana. So this function can be linear, non-linear, it's up to you. Okay. So the y here represents the demand. That means the number of bananas that people want to buy in that village within certain month. Okay. So then let's do sensitivity analysis. Yeah. If the small change in the price lead to very large change to the demand, then we say the demand is sensitive to price. However, if the price does not affect much to the demand, so we say the demand function is not sensitive to price. Okay. So example, this is the function, right? So I just plot, this is the price, this is the demand. Okay. Then you see two numbers. Yeah. So x0, we get y0, and then x1, you get y1. Right? So when we say delta, that means the change from x0 to x1, then there is a change from y0 to y1. Okay, so that's exactly the meaning of sensitivity. Yeah. So S is sensitivity, is just the ratio of the change. Yeah, delta y divided by delta x. That's it. Simple. Yeah. So then you can put this into percentage, yeah, because this is the difference. So you can put this into percentage. Yeah. So if the x is the price, y is the demand. Okay. So price sensitivity is obtained by dividing the percentage of change in quantity and the percentage of change in price. Okay. So meaning if you get this higher sensitivity number, then of course they are more sensitive to change of the price. Okay. Say, for example, you increase the price by 50%, then the sales drop 12%. Yeah? Then you will see the price sensitivity is just negative 0.24. Okay. So that means every percent of the price increase, it will impact almost 25%. Yeah. So for that, if you want to calculate the sensitivity analysis, you need to have the base value. Yeah. The base value is the x0 and the y0 here. Okay. So how to get the base value? The simplest is to use the average, yeah, or the median. Okay. So once you have this, then you can change toward the factor. Yeah. So I can introduce one thing. So how about instead of minus, you can just put, yeah, this is my idea, to put the factor, yeah, for example, the price of the banana into ratio. Yeah. So x1 divided by x0. Yeah. Based on this, we can plot sensitivity graph. Yeah, something like this. So if you get the sensitivity graph, then you can get the slope of this one. Yeah. By examining the slope of the sensitivity graph, then you know how sensitive it is. Yeah, if the slope is very big, yeah, the slope is just a trend, right? So if the slope is very big, then demand is sensitive. Yeah, the subslope is like almost flat. Okay, then the demand is not so sensitive. Yeah, by plotting, you can start to see that. But there are other way. Yeah, there are other way that you can use that. This is the example of demand function, and this is the sensitivity graph. Yeah. Over different value, okay, then of course the slope is also changing. So then you check which one is the x0. For example, x0 is 2. Then what is the value around here? Okay, depending. So you see here, this is very sensitive, and the trend is very big. And this one is getting smaller. Yeah, the trend is getting smaller compared to the first one. Okay. Now let's do the next point. Yeah. Can I increase my revenue? Okay. By how can I maximize my revenue? This is optimization problems. Okay. So we know that decreasing demands means you will sell less banana per month, right? Because you increase the price. Okay. Even though the number of banana that you can sell per month is reduced, does not mean that the revenue from your income actually reduced. Yeah, because demand reduced, but the price increased, right? So revenue is basically a price multiplied by the demand. Yeah. So okay. So in X is the price, Y is the demand. So that revenue is X times Y, isn't it? So in that case, we can calculate, okay, if you know the demand function, okay, we can actually calculate how can we maximize the revenue, meaning what is the price that you want to put in order to maximize this revenue. Yeah, this is an example. So this is optimization problem. Yeah, so example, you have a simple demand function linear. Yeah, Y is the demand, so 6 minus 4x, x is the price. Okay, and the current price is x0, 0.25 for items. So let's put this into numbers. Okay, so if you put 0.25 in here, so 4 times 0.25 become 1, right? So 6 minus 1 is 5. So you get y0 is 5. So then you want to ask, can I maximize my revenue? Okay, one way, and this is your demand function. Okay, then you calculate the sensitivity analysis graph with this straight line. Okay, and then now you calculate the revenue, of course. Right? Revenue is just the price multiplied by the demand. What will happen if you increase or decrease, yeah, based from the current price? And then you plot. Yeah, this is the revenue and this is the price. Oh, there is some maximum value here. So this is the price that you want to get. Okay, with this in this example 0.75. Right. It is interesting enough, yeah. So if you want to maximize the revenue, it is possible. Yeah. So in this case, can we calculate this 0.75? Okay. And the revenue. Yeah. This is the revenue is 2.25, right? Not using Excel, can we calculate directly? Yes, we can calculate using calculus, yeah. So, so if you have this demand function, and then the revenue is just multiplied, yeah, the price multiplied by this demand, so you get this quadratic, right, with this plot. Okay, then you can maximize the revenue by taking the first degree of derivative, yeah, and then equate it to 0, isn't it? Then you get this value, you get exactly the same, yeah, you get 0.75 and revenue 2.25. Yeah, exactly the same as your Excel. Yeah? It's not the green value in the Excel. Yeah, but we compute using calculus. Okay. So your calculus is still useful. Yeah. Don't say calculus is not useful.
We took this one, Doc, with Doc Chris, the transportation economics, sir.
Okay, good, good, good. So in that case, should I skip this part? Okay. So what happens if your demand function is actually not linear, yeah, but exponential, like this power function? Yeah. So in this case, you cannot find, yeah, the value. Yeah. So you cannot find the actual value. The actual value is only 0. Okay? Only minimum. Okay? There is no maximum revenue. Yeah. So last part is the price elasticity. If you know the sensitivity, okay, now you can take the ratio of this. Yeah. So elasticity is now unitless because now the change in the demand divided by that demand, okay, and then the change in the price divided by that price. It's called elasticity. Yeah, it's basically the same as sensitivity multiplied by that actual value, yeah, of the price and the demand. Okay, so why we discuss price elasticity of the demand? Because if you can calculate the price elasticity, then you can predict what kind of behavior. Yeah, so this E, price elasticity, okay, you will see the behavior. Okay. So if the minus E is larger than 1, that means this is elastic. Yeah, that means the change in the price is larger than the change in demand. Okay. Usually this is unnecessary product. Okay. If the elasticity is exactly 1, okay, that means the change in price is equal to the change in the demand. So that means the increase of the price does not change the revenue. Okay, so if your value is elastic, that means the increase of the price will reduce the revenue. Okay, but if your goods or service, okay, is actually inelastic, that means this is essential product. Okay, this is essential service. So that means increase of the price will actually increase the revenue. Okay, so if you know this, okay, then we can compute. Okay. Elastic demands, okay, means your product is actually, or the service is actually not necessary. Yeah, so you can easily replace with the substitute. Okay, so if you have very high competition in between companies, for example, airline industries and so on, so that demand is elastic. Yeah. So if you want to increase the price, the demand reduces so much. Okay. So same thing, yeah. If you, instead of the demand, you can also check the supply. Yeah. If the market price have elastic good decrease, then the firm likely to reduce the number of goods. Okay. How about if the demand is actually inelastic? Yeah? This means essential items. Yeah. For example, medication, food, gasoline, and so on. Okay. How about transportation? My question to you. How about transportation? Yeah, this is just example of computation, so you can check this is minus 0.05, so this is inelastic. Yeah. So how about transportation and education? How about parking? So you can check. Yeah, you can get the data and check by yourself, and then you calculate whether the demand is elastic or inelastic, and then from there you can see, yeah. Because if the people are actually captive, so this become necessity, so they cannot change. Yeah, regardless the price, they're captive to this. Okay? But if they have choice, okay, then demand become elastic. Okay. So up to here, any other question? I think if you learn this already, that's very good. So the last discussion I want to go with you is PEP. Now, please download. You want to rest first, or you want to continue with PEP?
Sir, 5-minute break.
Okay, I will stop the recording. Now. I'll continue again. Yeah. So, PEP analysis or break-even points. So I'll continue that. But this is our last part in this semester. So you see this part PEP. Okay. So this is the calculator of PEP that I make. Okay. So I can calculate the PEP and the plot, right? And then you can do some optimization by changing certain variables. Yeah, so you can change the input or you hold certain value. Okay, for example, you want to find the fixed cost, okay, based on different values here. You can change this one, okay, and then you can get the other value. Okay. Or you can find the product price by unit variable cost and so on. I'm not sure why it keeps jumping up. Well, let's go to the slide of this break-even point. Can you see the slide?
Yes.
Right. So this is the topic of break-even point. So I'm not sure we will discuss all or not, but I hope we can discuss at least until 9 here. Yeah. So the basic part is this one, 1, 2, 3. This is the classical PEP that you can learn in any other website or any other books. Okay? And this is the intermediate, usually in economic books, we'll discuss about profit analysis, gross profit, gross margin, and so on. Okay. And this part is my own proposal. Yeah, that using PEP, we can also think in terms of risk transfer, yeah, from employee to employer, and so vice versa. Okay, and then you start to see how we can use PEP to compute the cash flow and the capital. Okay, and if you want to go beyond that, so for example, what if the demand is actually random number, yeah, based on certain distribution, for example, normal distribution, or you have more than one product, or the PEP itself is not linear, it's also possible. Yeah. But this one I just scrap in the surface. Yeah. Okay, let's start this value here. This is advanced or optional. So what is break-even point or BEP? Is the point where the revenue is equal to the total cost, right? So this is the unit sales in the horizontal axis. Okay, and this is either cost or revenue in the vertical axis. Okay, and this blue line here is the fixed cost because it's fixed, so the value is flat, right? And then this is the assumption you have variable cost. Yeah, this from the fixed cost plus variable cost, then we have this red line here. Okay? So then the red line represents the total cost with this variable cost plus the fixed cost. Yeah. And then this black line represents the revenue. Again, this is very simple model of linear. Yeah, linear model, the three of them. So then break-even point is just the crossing, yeah, point here. Yeah, this is where there is no profit, there is no loss also. Yeah, so this is an equilibrium, right? So then question, why we want to study BEP or break-even points? Even though this is neither profit or loss, okay, but if you can calculate this BEP, then you know what is the minimum price to cope with the current demand, right? And then you also know what is the minimum number of sales to cope with the current demand, okay? And later, we can also think in terms of what is the actual risk transfer from employer to employees and vice versa. Yeah, this is kind of probability. And then say, if you know the revenue of marketer, if you put salary to certain worker like marketer, okay, so what's supposed to be the revenue in order to reach just BEP? Yeah. So what will be the minimum capital needed for your business? Yeah. What will be the minimum cash flow? Yeah. This is the thing that we will answer in this slide. Okay. And what is the minimum price? If you change the capital, okay, what will be the minimum price? Apparently, the price is not just depends on the demand. Okay? That also depends on how much capital you have. Okay. So then you will also understand how the small trader and large distributor work. Okay? And then based on that, you will understand why the company bankrupt. Yeah. Sometimes just because the delay of payment. Yeah. What is the probability of profit and loss? And then what is the expected money value, monetary value, yeah, EMV, for the given demand? So this will be answered all in this slide, yeah, in this topic. Okay. So first of all, you need to understand certain fact, yeah, about BEP. So BEP is an equilibrium point mathematically, right? Where the total cost the same as revenue. So this is not something that you want as a company. Yeah? It's not desirable. Okay. And this is something that you compute regularly on daily basis, probably, or a monthly basis. Why? Because the demand keeps changing, isn't it? Yeah. And the BEP model that we discussed, mostly linear, okay, but remember, this is just model, not necessarily linear model. So in the end, I will show you it is possible to make it non-linear. Okay. So these are example, yeah, of costs in engineering, probably the equipment, the travel, labor cost, overhead, and so on. Yeah? So, and to decide the price, okay, there are many factors as well. Yeah, probably based on the contract, based on the requirement. Yeah, it depends on the financial health of your company. For example, you are having difficulty, yeah, to get certain projects, then you probably want to lower your price, right? So this is not included in our PAP analysis. Yeah. So what is included in our PAP analysis is just based on this assumption. Okay. This is the most important assumption in PAP analysis, that the cost, okay, can be divided into two parts. One is called fixed cost, and the other one is called variable cost. Okay, so what is fixed cost? Fixed cost is the cost that incur in your business, even if your business does not have any production or sales. So that means fixed cost is the cost which does not vary with the volume. Yeah. Yeah. And what is variable cost? Is the cost that directly proportional to the number of productivity or your sales. So variable cost is always varies based on the volume. Okay. So now our goal in PAP analysis is to reduce this fixed cost, okay, and then transform it to variable cost. Okay, I give you several examples first. What is fixed cost and what is variable cost? Yeah. So fixed cost usually called overhead cost. Yeah. It will not change regardless how much you sell or you produce. Example is your salary as employees. Okay. You build a building, office space, whether you rent or buy or loan, that is fixed cost. Okay. You buy equipment or furniture or you lease, okay, that is also fixed cost. Your computer, yeah, you buy license, your electricity cost, your phone in the office, yeah, you buy generator for electricity and so on. These are fixed costs. The cleaning, yeah, in janitorial cleaning, yeah, in the toilet of your office is also fixed cost. Management, yeah, so your secretary, the boss, okay, including the maintenance of hardware, vehicles, and so on, they are fixed costs. Why? Because whatever you produce, whatever you sell, you still need to pay exactly the same amount. So it doesn't change based on the volume of your production or your sales. Okay? So these are other example of fixed costs, yeah? But this now depends on the context. Okay? So training, staff, membership, subscription, consultation, and so on. Yeah, bank charge, interest, and so on. Yeah, marketing promotion can be fixed costs, yeah, depending on the context. Yeah. So in that case, what is variable cost? Yeah. Variable cost is the cost of the product sold that is completely dependent on the volume or the sales. So example, your incentive for a project, your bonuses, your overtime, yeah, your materials. If you buy, so you are a trader, yeah, so you buy per item, that is variable cost. Yeah, your packaging probably, yeah, that's variable cost. So let's practice a little bit, yeah, because this is the most important part in PAP. If you cannot distinguish variable cost and fixed cost, you cannot do PAP, right? So let's do. What do you think about transportation material from supplier to your warehouse? Are they variable cost or fixed cost?
Variable.
Okay, so how about employee training? Okay, so you type here. No, not variable per kilometer. Variable cost is not different meaning. variable cost does not mean variable change, okay? Variable cost means depends on volume, sales or production, not based on per kilometer. Okay, so remember the definition of variable cost here is does not mean variable change based on kilometer or any other factors. So how about your profit? Is it variable cost or fixed cost? You may say, I thought BEP is no profit, right? So, but again, definition of fixed cost and variable cost, okay, you stick to this definition. Yeah, variable cost is the cost that depends on volume or the sales. Okay, while fixed cost is variable that does not depend on volume or sales. Okay, so yes, profit is revenue minus cost. That's correct. So in that case, profit can be put into fixed cost or variable cost. Yeah, depends on how you will put it. Yeah. So first of all, let's discuss variable cost. Yeah, in production, okay, some in the business book sometimes we call this COGS. Yeah, cost of goods sold. Yeah, this represent direct production cost. Yeah, for example, the material, the labor, the storage. Yeah, is the price of good that when you purchase that. Say you are a trader, you purchase the goods that you buy and then you want to sell it again, right? So this is called variable cost. Yeah, in service, this is the cost of sales. So the cost of one unit service multiplied by the number of service. Okay, so important here is unit cost per item multiplied by the number of items. Yeah. So variable cost is always this one. So I will use variable cost is capital V. Yeah, small v is the unit cost per item. N is the number of items. Is that okay? Okay. Consistently, we use the same notation here. So when we say sales, yeah, sales is the same as revenue. So I will use this notation R, okay, revenue, and this is represent the sales. P here represent the unit price that you sell, and N the same things. Yeah, N is the same number of sales. All right. So P is the unit price, so meaning price per unit goods or per unit service, and then N is the volume, yeah, or the number of sales. Yeah, demand. N is the demand. Okay. Revenue is price times the demand, right? In sensitivity analysis a while ago, we use X and Y, so we just use different notation here. I hope you don't get confused with that. Okay, so total cost is the variable cost plus fixed cost. Yeah, so this yellow part here is called fixed cost, and the horizontal axis is the number of sales or the volume. The vertical axis is the cost or the revenue. Okay, so the green part here is the variable cost. The blue line here is the total cost. Yeah, and the black line here is the revenue. So the BEP is just the intersection between the total cost line and the revenue line, right? So remember, total cost is the variable cost plus the fixed cost. But the fixed cost here, the capital V, is equal to the unit variable cost multiplied by the demand, yeah, the number of sales. And then F is the fixed cost, right? Then what will happen? BEP happen when the revenue are equal to the total cost T. Yeah, but T here is equal to V plus F, right? So, but the capital V here is equal to V times N. So in that case, I can put this V times N, the small v times N, plus F. Yeah, so the blue formula here, can you see this? Okay, so there is n in the left-hand side, there is n in the right-hand side, so I can just use algebra, put it in the same side, okay, and then I can put into this formula, yeah. So why I put star here? Because this is BEP, yeah. Again, this is the revenue star, that means this is the BEP. BEP means the total cost equal to the revenue. Is that okay? So from here, we can also introduce another value, which is called gross margin. Yeah, gross margin is just 1 minus the unit variable cost V divided by the price. Okay, so later you will see we have also gross margin at BEP. So I put that as G star. Yeah, this is equal to the fixed cost divided by the revenue. So based on this simple derivation, so I just put this red formula here into the next slide. Okay, so BEP is just a fixed cost divided by the selling price minus the unit variable cost. Yeah, so I put star here so that you will know that this is BEP. Yeah, this is the demand at BEP. Okay, so this is something that you pay, and this is something that you get. The variable cost, fixed cost, total cost, these are the variable cost, the thing that you pay, isn't it? So the price is something that you get, the profit is something that you get, the revenue is something that you get. So in between what you pay and what you get, yeah. So PEP can be used in production or in sales, right? So if you use PEP in production, the N represent the volume, okay, that you use to produce per time. Okay, so if it is in sales, this is easier. So this represents the number of sales per time. Up to here, is it clear or not? So this is the basic PEP. Any question? Yeah, I think you learned this already. So next is profit. So profit just revenue minus total cost, isn't it? So let's put this into notation. Okay, so profit P, so I put P, revenue still R, and total cost, the capital T here. Okay, so profit is revenue minus total cost. So then profit is revenue minus total cost. The revenue you already know, which is N times P, and, okay, minus the, so N times P is the revenue, isn't it? The total cost depends on the fixed cost and the variable cost, right? So now you can use this formula to get the profit. But at PEP, the profit is 0. Then this is the question. What if you insist to use PEP, okay, but you still want to accommodate the profit? Okay, what if you insist to use PEP, but you want to include the profit, but you still want to use PEP formula? Okay, in that case, there are two possibilities. Yeah, you will use profit as a fixed cost, or you will use profit as variable cost. All right. So let's say you want to use profit as fixed cost. Remember, profit equal to revenue minus total cost. Okay. So because P is constant, okay, this one, right? So then you will see this value. Yeah. So remember, NP, this is revenue, minus F, minus NV. So then I can put this P here in the other side. Can you see? Okay. Then I equate this to 0, right? Then from here, we can use algebra. Okay. You can see that this is actually, what is this? This is the new fixed cost, isn't it? This is a new fixed cost. Okay, so if you compare this, NP minus F, yeah, and then minus V, and compare this one. So you will see that this is actually new fixed cost. Yeah. So when you put profit as fixed cost, okay, you will have new fixed cost, which is a little bit higher. Okay. But question is, how if we use a profit as variable cost? Okay. Say we use this definition V subscript P as variable cost, which is actually profit. Okay. And then we have the V star, which is variable cost at PP without profit. This is the original PP. Okay. Then you will have a new variable cost, which is based on the PEP and variable cost as profit. Okay. So without the profit, you will have this formula a while ago. Let's call this N1. Okay. Now with the profit component, okay, again you put it in, but now instead of that, so you can this V here, you will have this V star plus VP. Okay, and then you will see the value here. So compare this N1 and the formula here, then you will see, okay, that N is actually N1 plus N2, yeah, which is from PEP plus the actual value from the profit. That means we can use PEP, the same PEP formula, yeah, by including profit inside, either as fixed cost or as variable cost. Is it clear or not? The point of explaining this formula. Okay. Even though the original PEP is mean no profit, okay, if you insist to include the profit, you can either put it as fixed cost or as variable cost. That's the meaning of this formula. Okay. So, okay, let's start with example of number. Can you calculate this one? Say you have a business with a monthly fixed cost, 36,000. So unit variable cost is $4 per item. Yeah. Selling price is just $10 per item. Suppose this sells 11,000 items. This is the demand. Right. So then I will know how much is the break-even point. Yeah. So when we say break-even point, that means the N star. And how much is the monthly profit? Oh, this is interesting. Okay. Yes. Yeah, correct. So 6,000. Yeah. So put all of this into the formula. Okay, so we have F, which is 36,000, right? And then we have P, which is 10, and then small v, this is the unit variable cost is 4. Then you have the break-even point of 6,000. Okay, so that means any demand beyond 6,000, you will make profit. Okay, and then if your demand is less than 6,000 per item per month, you will get loss. That's the meaning of PEP. Okay, but it's given here. Your actual sales this month is 11,000. So how much is your profit? Oh, so the revenue is the 11,000, right? Multiplied by the price, isn't it? And then the fixed cost still 36,000. The variable cost now 4 here multiplied by the sales, so 44. Okay. Then you calculate the total cost, okay, and then you can get the profit, yeah, which is 30,000. Is it clear or not with this example? Is it clear or not? Do you need some time to absorb this example or clear? Okay.
Third question,
Yeah.
in how many months that the leaves will be attained something like that.
Later,
Like
when
that,
you
yeah.
want to calculate months, yeah, later we can
Yeah.
calculate.
All right.
At this point, every month you need to compute, right? Because demand change every month. Yeah, if you want to calculate the months later when we have the capital and the cash flow, we can calculate that with the months. Yeah. Okay. So say yes. Can you cite an example when we will use the formula? Or when are you going to use the profit for fixed cost or variable cost? Oh, good question. So now depends on you. Yeah. So if you think this is a profit as a fixed cost, okay, say for example, this is your own business, right? And then you put your profit as a fixed cost, that means you pay to yourself. So every time that you pay to yourself, that become a fixed cost because you make a regular amount to your salary. So that profit become fixed cost, right? But now you can put that also as variable cost. So because you in BP analysis, okay, what you want is actually to reduce the fixed cost, right? So in that case, what if we put that profit into variable cost? Then what will happen if you put that into variable cost? Then the number of sales that you need to do become much higher. See, N is equal to N1 plus N2. Yeah, yeah. N1 is coming from the PEP with no profit. N2 is coming from your profit that you set here. That's the meaning. Is this answering your question? Okay.
Yes, sir. Thank you, sir.
Yes. Okay. So let's say another example here. Say you are trader, right? So you buy an items, say $1.5 per items. And of course, every month you need to pay yourself salary and so on. So this is the fixed cost, say $90 per month. And then you sell at double price, yeah? Okay, so you sell at $3 per items, per products. So the question is, how many items do you need to sell per month in order to reach no profit nor loss, yeah, break even? And then what is the minimum sales at that break even? The end. And then the next question, suppose the demand of this one is 100. Is it profit or loss? You want to practice this for a while? Yeah, the answer is just there. If you practice a little bit, then we will understand probably better. The thing you need to remember is just one formula. This one. Demand or PEP is equal to fixed cost divided by P minus V. So if you know the fixed cost is 90, and then this one is 3 minus 1.5, so then you divide, you get 60 items. Okay, at this point, you get revenue of 180. Okay, so what is the meaning? If you want to, yes, 60, 180, that's correct. Okay, so to reach the break-even point, so you need to sell 60 items. 60 items mean this month you need to sell 60 items. If you cannot sell 60, you will get loss. Yeah. If you sell at exactly 60, you don't get profit either. Okay. This is the revenue when you sell at 60. Okay. So the minimum sales, okay, should be 180 minimum. Okay. So now if your demand is 100 items, of course, now the revenue is 300 above 180, right? So in that case, you get profit, isn't it? But be careful when you calculate the profit. Yeah, the fixed cost is still the same, right? Because fixed cost does not depend on the volume, not depend on the sales. But the variable cost change, remember, okay? Because now the variable cost is now 1.5 multiplied by the n. N is now not 60 anymore, now become 100. Okay, so you need to change this volume. Okay, then you calculate the total cost. Okay, and then from there you can just minus, yeah, the revenue minus the total cost, you get profit. Okay, so this next example or next practice, can you do this? Can you practice this one? So this is non-profit social activity. Yeah. So we sell food at $3 per meal, and then ingredient cost us 1.5. Yeah. Hey, this is non-profit. Okay. So the demand is say like 200 meals per day. Then you hire daily worker. Yeah. Say $100 per day, including one owner. Okay. So question, how many more workers can we afford to hire? So how do you know how many more workers? So you need to get salary. Salary means fixed cost. Okay, so you need to get fixed cost in here. Can you calculate the fixed cost? Can you tell me the difficulty in this part? Yes, the fixed cost is 300, that's correct. Okay, so but one worker is 100. That means 3 workers you can afford to hire, but including yourself, that means 2 more. Yes.
Two persons, sir.
Yes, 2 more persons. Okay, so because of course not including yourself, yeah. So formula is the same, you see, yeah. So because now you have this one, so F is just going down here, and if you multiply, yeah, so N multiplied by P minus P. Okay, so you get 200, so you get 300, then divided by 100 per worker. So you get. Okay, very good. Very good. Yes. Yes. Okay, now PAP analysis is not panacea. So not necessarily you can use PAP anytime. Yeah. So when you cannot use PAP, yeah. So if you want to use PEP analysis, you cannot sell at loss. Yeah, you cannot make, look at this, P minus V, right? This one, you cannot make it minus here. So P must be larger than V, right? So this is the PEP assumption, yeah? The price must be larger than the variable cost, the unit variable cost, yeah? You cannot make it equal either, because remember, if you make it equal, this divided by 0, right? So must be larger, cannot be equal. Okay, that's the assumption here. So geometrically, if you plot continue, okay, if you make P is less than V, you will get PEP at this region. Yeah, if you negative, so you will get the PEP at this region with this negative revenue, negative demand. So this is not allowed. Why? Because against this PEP assumption. Okay, but in reality, okay, in business, this happened, right? Why? Example, yeah. You are holding out the trend of out fashion goods. Yeah. So in that case, you may consider selling at loss, isn't it? Okay. So in this case, you cannot use PEP. Yeah. So or your food, you are selling food, for example, this expired. So then you are forced to sell at loss. Again, you cannot use PEP for this. Yeah. Or the storage cost is very high, so then your good is out of season. Yeah. So if you want to put your clothes, winter clothes, for example, and then you put it in the storage, okay, even though maybe this is out of fashion is one thing, but you can still sell it next year. But if you put it in the storage, it's very expensive. As the storage cost is expensive, then in that case, you sell at loss. So in reality, a lot of people have different problems, you know. Okay, people will have retirement, divorce, sickness, death, right? Or you promise to your spouse or girlfriend expensive trip, right? Or any emotional reason, right? So in that case, you will sell at loss. In that case, again, you cannot use PEP. Okay, so this is the strict PEP assumption that you need to use. Okay, yeah. So not every time you can use PEP. When you sell at loss, you cannot use PEP. Okay, so the next lesson, okay, so is about gross profit and gross margin. So I introduced two new terms, yeah, gross profit and gross margin. So what is gross profit? Gross profit is basically sales revenue minus the variable cost here. Yeah, so I will use rho represent the revenue minus variable cost. Okay, and why we are doing this? Because at PEP, yeah, the gross profit is just the same as fixed cost. Yeah, you can calculate. So this revenue minus variable cost, the capital, okay, and then you put it out. R is N times P, right? Small capital fee here is the variable cost is the same as a unit variable cost times the demand. So you put it out, and then you will see that this is equal to fixed cost. Okay, and then of course this one gross profit you can put it as per item. Yeah, so I will use small r. Yeah, from at PEP, yeah, the N is equal to F divided by this gross profit per items. Okay? So say you are selling an items for $1, okay, and the cost you buy is actually 90 cents to produce or to buy. Okay, so how much is your gross profit per items? So then you just plug into the formula. Yeah, that means 0.1. Okay, so now if you know the gross profit per item is 0.1 and you want to achieve certain target gross profit of say 5,000 per month, so then the question is how much sales do you need to get in order to achieve that target? Okay. And next question is if you have the fixed cost, say 2,000 per month, okay, how much will be your profit? Okay. So based on the formula a while ago, okay, this one, rho is just NR, right? And R is equal to P minus V, okay? And this formula, then you can calculate items, yeah, this one. So N is just rho divided by R, so you get 50,000 items, and this is the profit that you will get per month. So again, if you know the gross profit per items and the fixed cost, yeah. So if you know the gross profit per item, small r here, and then the fixed cost, okay, then you can calculate how much is the sales, the variable cost. Yeah. So if you know the target profit and the fixed cost, then you can get the number of sales minimum to cover your overhead costs. So then you can calculate using the simple formula. Yeah, but be careful, yeah. When we put N star here, that's the number of sales or the demand, right? That means this is no profit. Yeah. Okay. So the next jargon that I want, or the next terminology that I want you to understand, this is very important. You can forget the gross profit, but this one, don't forget this one. Yeah, but because this is very important. Yeah, gross margin. So gross margin by definition, okay, is this red formula here. Okay, but this gross margin indicate how efficient the management use the labor or supply in the production process. So this gross margin is the same as profit, gross profit a while ago, divided by the sales. Yeah, this one. Okay, gross profit divided by sales. Okay, so this is the same as revenue because gross profit is equal to this one. So revenue minus the variable cost, okay, divided by the revenue. Okay, which is the same as gross profit per item per price. Okay, so R divided by the unit price. Okay, so if you confused with so many formula, I want you to remember only one formula here. This one only. Yeah. This one. Can you remember just this one formula? In fact, you can few formula that you have. Okay, so let's practice so that you can get. So you are selling. This is the price, and this is the cost for a unit. Yeah, this is unit price, and this is unit variable cost basically. So, say you are a trader, okay, or you are a factory. You have a factory to produce, or you are trading. That means you buy. Okay. So, question is how much is gross margin? Yeah. Gross margin is, gross margin is just R divided by P. Yeah, R is just P minus V. So then gross margin in this case is 10%. Yeah, this is just plug into the formula. It's not so difficult, right? Okay. What if long-term planning like a year? Every year there is an inflation price. That's the inflation price affect the formula or embedded gross margin? Good question. So when we compute the PEP, okay, we are dealing with the change of demand. So then you calculate per month, for example, or per week. Okay, so if you want to calculate inflation of the price, okay, then you can put that inflation of the price where it will increase. Inflation of the price, you will put in the fixed price or in the variable price. Okay, actually depends. Yeah, you will include in the both side. Yeah, because the fixed price represent the salary. That means because of inflation, the salary will increase. So the fixed price increase. Okay, and then the variable cost. That means the things that you buy from other people. Okay, that will also increase. So in that case, the inflation will increase both sides. Okay, the fixed cost and the variable cost. Okay, so it doesn't affect the gross margin at all. So because this represents both sides, the price will change. Because if you fix the gross margin, okay, then you need to calculate how much is the price. Okay, maybe the next example will give you better understanding. Here, suppose you have the cost to produce is $1, okay, and then you fix this gross margin, 75. Okay, so how much is selling price? So you remember the formula a while ago? G equal to what? 1 minus V over P. Yeah. So G equal to 1 minus V divided by P. Okay. So I know G is 0.75. Okay. So if I know the cost of the product with this V, okay, can I get the P price? Yes, $4. Okay, the price is just $4. Okay, so in reality, this is what you use. Okay, you fix your gross margin, and whenever the change in the price that you buy, then you change the price, your selling price, isn't it? Okay, so what's the connection between gross margin and the profit in that case? Yeah, this is the derivation of the formula. Yeah, so P here is the profit. Yeah, this is the profit. This is your demand. Okay, and this is your unit price. This is your gross margin, and this is your fixed cost. Okay, so if you know the demand and you know the price for items, and gross margin is the one that you put as fixed. Okay, then if you know the fixed cost, then you know your profit. Okay? Or you can target, yeah. So you can target the profit that you want, and you know the demand and the price, and you know the cost that you have. Okay, then you target what is the target gross margin that you want. Yeah, so you can reverse that using that formula. Yeah. So here, in this example or practice, yeah. So your business is selling that a while ago, $4 per item, yeah. And the gross margin a while ago was 0.75, right? So 75%. But now we have the demand, 2,000, and you have the fixed cost. So how much is your profit? Okay, all you need to do is just use that formula. Yeah. So I already derived it for you. So if you don't want to do this, so you need to derive on your own. Yeah, I think it's good if you can practice derivation of this formula so that you can understand better. Yeah, otherwise you just use. Yeah, so if you know the actual demand, you know the price, unit price, and you know the gross margin and the fixed cost, then you know the profit. Okay. So next is what is the gross margin at PEP? Yeah, so let's see this. By definition, okay, this is the definition of total cost, isn't it? Total cost is the fixed cost plus variable cost. Okay, and then by definition of gross margin a while ago, again, G is the revenue minus the variable cost divided by the revenue. Okay, so but remember at PEP, by definition, okay, total cost equal to revenue. Yeah, so P equal to R. Then you can put them together. So that means at PEP, yeah, T is equal to R. That means what is the gross margin? The gross margin is T minus V, yeah. So this one, yeah, T minus V divided by R. It is equal, but T minus V is, yeah, here, T minus V is actually the fixed cost. So at PEP, yeah, the gross margin equal to the fixed cost divided by the revenue. Okay, so this we can use. Okay. So example how we use this. Yeah. So say your business is selling the product at a while ago, 75% gross margin and $4 per item, right? The selling price. Okay. Now let's change the fixed cost. Okay. Now the fixed cost is not 2,000 anymore, but 6,000. Yeah, because you are generous to your worker, so and you want to hire, they want demand more people to work with you, so you hire 3% instead of 2. Okay, so you get the fixed cost of 6,000 per month. Question is, how many items do you need to sell in order to survive? Yeah. What you want to get? N. Yeah. So given your hey, this is the PEP gross margin, right? Okay, so we know this is 0.75. Okay, so this is what we are given. Okay, and we use this formula. So you need 8,000. Yeah. So and the N here is now become 2,000 item per month. Yeah. So if you compare this 2,000 item per month compared to the earlier, what's the difference between this example of fixed cost 2,000, right? So in here you sell 2,000 item also, right? The gross margin. And in here you also sell at 2,000. Oh, what's the difference? Okay, the difference is in the profit, yeah. Okay, so if you compare this, okay, the same amount of items sold, right? In the previous practice, okay, we are talking about profit here, P. Okay, you get profit of 4,000. Okay, at this point, you get star here. That means you neither loss or profit. So this is not the thing that you want. So practically, if you hire more people, your profit is distributed among the worker, not become your profit anymore. That's the point. Yeah. So in that case, what kind of lesson we can gain from all of these simple formulas? Yeah. Okay. So we have this two formulas here. Okay. So look at this formula of gross margin and gross margin at PEP. Yeah, the one with the star here is the gross margin at PEP. Okay, So of course, you want to increase the gross margin. Okay? How you will increase the gross margin? By increasing small, to increase the gross margin, yeah, you increase the selling price, isn't it? The P here, yeah, and reduce the variable cost. Is that correct? Or of course the two of them, yeah. So if you want to increase the gross margin, okay, you increase the selling price or reduce the cost. Logic, yeah. But okay, if you want to survive in business, okay, then you want to reduce the BEP gross margin. Can you distinguish gross margin and BEP gross margin? They are not the same. Yeah, so this is called BEP gross margin. So with the star here, the BEP gross margin is F divided by R. Okay, so in this case, what you want? You want to decrease the BEP gross margin, not to increase. So be careful. Okay, so you have how to reduce the BEP gross margin. Oh, if you want to reduce this, of course, you reduce the fixed cost, right? And you increase the revenue, yeah, go up. This one is going down, yeah. Is it clear or not? So remember, yeah, I summarize again. Yeah, always look for ways to increase your gross margin and to reduce your BEP gross margin. This is the summary. How? So I put it this way, yeah. The gross margin you want to increase, the BEP gross margin you want to reduce, yeah. Increasing the price, the reduce variable cost, increase the revenue, and reduce the fixed costs. Up to here, is it clear or not? Any question? So now this is the difference between sales and business. Yeah. So in the sales mentality, they will never ask about the profit. They only care about sales, sales, sales. Sales means revenue. Okay. In business mentality, of course, you care about profit, not revenue. So in this case, you care about increasing gross margin, yeah, or reduce the BEP gross margin. Yeah, this is what you need to do. Yeah. Okay. Don't just increase your revenue, okay? Because revenue does not mean profit. Okay, revenue does not mean profit. Yeah, this is very important lesson. Many small business owner, yeah, small SME, yeah, small medium enterprise, they mistakenly think that the revenue from the sales is equal to profit. This is mistake, common mistake. Okay, and then this small business owner forget the overhead costs, yeah, of her own food. Yeah, this is the example. Can you try this one? Okay, don't look at the answer, but try this one first on your own. Yeah, because this is important to understand the concept. Okay, so this is small business. Say Lola, yeah, open a small fish shop. Okay, she bought the fish at $20 per item, say 1,000 pesos, right, in the market, and then sold it at $2 gross margin per item, yeah, the small R. Okay, so every month she can sell 100 fishes. Yeah, she owns the shop, but her own food costs, say, $500 per month. Yeah, it's 25,000 pesos about. So the question is, how much is her revenue? How much is her profit? And then question is, can she survive in business? Try to compute this. So what is this? $20 per item. What is this?
Variable cost.
Yes, this is variable cost, yeah, small v, yeah. How about this $2? Yeah.
Revenue.
No, this is not revenue. This is gross profit per item. R. Okay, okay, I will put it in the variable so that you can get. Yeah, this is R is the same as P minus V. Is that okay? So every month she can sell N 100 pieces, and then F is 500. Okay, with this I think you can do it. You want to share your screen? Oh, okay, you just chat me. That's okay. How much is your revenue? Okay, revenue. That's correct. So 2,200. Okay. And the total cost, that's also correct, 2,500. Yes. So how much is the actual profit in that case? P minus. Yeah, yeah. The price, correct. The price is 22. That's correct. Yeah. So we are not asking about the price. We are asking about her revenue and the profit. Yeah, that's correct. Yeah, the R is 2,200. That's correct. So question, can she survive in business? Negative. Okay. So right. So this is the price is 22. Yeah. The revenue is just N times P, right? So 2,200. Yeah. The total cost is P equal to F plus V. Okay, so this capital V is small v times N, right? So you get 2,500. Then the monthly profit is actually minus. Okay. This is the common mistake in small business, isn't it? Actually, this business is not profitable. Why? Because, okay, she mistakenly thinking that the revenue is big, right? Okay, this is much higher than my cost, 500. Then I will survive in business. No, actually you are subsidizing. Yeah, yeah. The monthly profit is actually negative. Yeah. Well, in the positive side, you can say, yeah, at least her monthly profit support her living cost partially, right? That's okay. Yeah. But in terms of business, this is not profitable. Okay? I hope you understand. How important BEP is, yeah, to compute this. Now, if you hire a marketer, say a worker, usually the production of that worker or the sales of that marketer must be higher than the salary, isn't it? Otherwise, why you hire someone else, right? So now the question is, suppose I know the salary of that marketer or a salesperson, yeah. So if you hire a salesperson, you are making an investment, right? So then how much is the expected return of investment? Yeah, how much should be the actual sales? Okay. So this is an example. Okay. Suppose the person costs you, this is the salary per year, yeah, 75, 45, and then you still give other benefit. Yeah. For example, 5,000 for the phone, raffle, whatever. Yeah. So, and then of course you're supposed to set the gross margin, yeah, okay, say 40%. Okay, then you need to, that salesperson need to get 125,000 in sales. Okay, so that the total will be 50,000. Yeah, 45 plus 5,000 is 50,000, isn't it? So to cover their expenses, okay, they need to bring in much higher. Okay, so then question, how to get this number? Yeah, this 125. Yeah, from that formula a while ago. Yeah, so how much should we target the salesperson? Yeah, so that the salary is worthy if you know the gross margin. Yeah, so yeah, we used this formula a while ago that we use. Yeah, it just reverse. Okay, so R equal to, yes, so R equal to fixed cost divided by the gross margin. Easy. Yeah, correct. So we become get it as 125. Okay, so now if you are selling an item, okay, at $1 a while ago, okay, and then if you buy is 0.9, so 90 cents, and then you need 5,000 per month to cover your overhead. So remember, when you hear overhead, that means fixed cost. Okay, how much sales do you need to get at least to cover your overhead? So this is simple PP formula. Can you calculate? I'm supposed to put this in the beginning. Yeah, so if you know the F, right? This one is P, small p. Yeah, this one is small v. Yeah, so then you can calculate. So the PP, yeah, is just N equal F divided by P minus V, and this is the PP formula and the sales. Okay, up to here, is there any question first before we go to the next topic? Okay, so far so good. So now we want to go to our goal. Yeah, our goal is to transform fixed cost into variable cost. Yeah, this is probably the main point. Yeah, so I put this fixed cost, variable cost transformation. So say you have 4 possible scenarios. Yeah, fixed cost is high, yeah, or low. Yeah, variable cost is high or low. Okay, then what will happen? Okay, so I put here in the chart, yeah, so that you can compare. Then you need to use the same revenue line, isn't it? So how do I know it is the same? So you see the slope of this black line is the same for all these 4 scenarios. Okay, and then the variable cost is represented by the slope of the total cost. Yeah? Okay, so low variable cost, a little bit flatter. Okay, and then high variable cost is steeper. Okay, so this one is high fixed cost, low variable cost. This is high fixed cost, high variable cost. And then this is low fixed cost, low variable cost. And we use the same slope. Yeah, and then this one is low fixed cost, high variable cost. Yeah, of course, the fixed cost represent the intercept of the total cost. Okay, so if you look at this, uh, 4 scenarios. If you are the owner of the company and you are the employer, which of these 4 scenarios is better for your business? And then if you are the employee, which of these is actually better for you? Remember we do game theory last time, so everyone is having self-interest, right? So
If I'm going to be the business owner,
uh-uh.
I will choose the lower left, low fixed cost, low variable cost.
Oh yeah, the ideal one is lower fixed cost, lower variable cost. That's correct. Okay.
But
So
if I'm the employee,
so you want higher variable cost, fixed cost. Yeah. If you are the employee, you want fixed salary. Right. That's exactly the contradiction in the business. Okay. So for the owner of the company, it is better fixed cost is low. Yeah. But employee is seeking stable income. In that case, there is a contradiction. They want they don't like low fixed cost. Yeah. So if you look at this example, okay, I try to make it as realistic as possible, the number here. So say you have a consultant firm with 5 engineers, yeah, and then 1 secretary, and you yourself. So say each engineer you pay 30,000, for you is 60,000, and then secretary is 20K. Yeah, in the Philippines, 13 years, 13 months per year, right? And then say you keep incentive, so this is the variable cost. Okay, and you also have fixed cost, yeah, of 100,000 per month. Yeah, so then say let's make it simple. So make average project price is 1 million per project. Then the question is how many projects you can get per year to get at least PEP. And then if your team can accomplish 1 project per year, how much is the minimum price? Okay, so this one we can compute in Excel, depending on the number of projects. Yeah, so at PEP you're supposed to get only 5 projects per year. Yeah, which is about 5 million pesos. Yeah, because you have 5 engineers, so each engineer income is about 410,000. Okay, so this is a variable cost. Now we can compare what will happen if you change. Yeah, you change so that the salary reduce, the bonus increase. Remember, bonus represent the variable cost, right? So what will happen if you do that? Okay, so assuming, of course, the same PEP. Okay, assuming the same PEP, 5 projects per year. Okay, then you will see, okay, its engineer income is actually increased per year. Okay, that means if the number of project you can get exactly 5, okay, you neither loss or profit. If the number of project is actually higher, okay, and then the engineers, the employee will get much higher also, right? But why the employer want to do this? Yeah, because if the number of project is lower, then the risk to the owner is actually lower. Okay, so this is assuming all the price remain the same. So can we if you want to transfer all the risk, yeah, to the engineer, okay, in that case, you will do what is called outsourcing. Yeah. So in this case, you will put the maximum variable cost and then the minimum variable cost. Okay. So the minimum variable cost, the minimum fixed cost. Yeah. The minimum fixed cost, of course, include this your cost and the secretary, and of course the rent, utilities, and the others. In that case, yeah, in this scenario, the engineer income drastically increase, and outsourcing increase their salary per year at peak. Yeah. At the same time, you also improve the risk, yeah, for the employer, for the owner of the company. Yeah. This is our goal. Yeah. So reducing the fixed cost as much as possible and then exchange it into variable costs. Actually, it will increase the morale of the employee because the salary is the overall salary increase, yeah, overall profit also increase, and then it become productivity wages. Okay, so the idea is to transfer the fixed cost into variable cost. And so you make it lower by increasing the variable cost. Okay, so if you do this based on PEP, okay, then you will see what is called, there is variables, yeah, that you can use to calculate the probability of this. Okay, so shifting the risk from employer to employees and vice versa. Okay, at zero of this, zero fixed cost, that means you outsource everything, right? At zero variable cost, that means you pay full-time salary without bonus. Okay, so I do several trial on what kind of index I can use. Okay. Finally, I found one index with this can do all of this. Yeah, and when we compute this index, yeah, which is the same as F divided by T, okay, this is exactly what we want. Okay, but at PEP, okay, this index is exactly the same as gross margin PEP. This is interesting. Yeah. So apparently, PEP gross margin G star, it behaves like a risk probability to transfer from full fixed cost to full variable cost. Okay. So in this case, you look at it this way. Yeah. If at PEP gross margin 0, that means it's 100% risk to the employees. Okay. So if gross margin 1, that means 100% risk to the employer. So you need to understand this risk transfer. Yeah. So now if you know the PEP gross margin, then you know how much is the actual risk. Okay. So this is at least this gives us insight about your own business. Okay. So you can practice all of this practice, and I give you all the answer also there in here. Yeah. So next point, sorry, I know that time is finished, but next point is the one that I think you need to understand, that PEP can be connected with capital and cash flow. Okay. So let me go here. Yeah. So why business go bankrupt? Because of certain delay payment. Yeah. Because there is not enough cash flow. Well, that is one of the main reasons. Okay, why the business bankrupt. Yeah. When they don't have enough capital to run the business, so no regular cash flow, and they cannot borrow, then of course the business collapse because the worker will not work for you anymore. Okay. So lack of cash flow is the actual reason for many company bankruptcy. Yeah. So in that case, how can it become lack of cash flow even though you get revenue? Yeah. One of the reasons is because of delay payment. Yeah. If you delay if your clients delay the payment, okay, then the amount of delay payment for many months, that is the actual risk for you. Okay. But delay payment is actually common in business, right? So you buy materials, some delay, you buy ingredient for the restaurants, you pay first, and then you wait until someone else buy, isn't it? So with that, we can actually model this one. Yeah. So the model is you can put like this. Okay. So you can model based on how many months. Yeah. So if you look at this Excel file, so you put the fixed cost and the variable cost, okay, and then you accumulate. Okay. Then you can start to see at which point you are at PP. Okay. So based on this PP points, then you can get, remember, sales is not the same as profit. Yeah? So in that case, why you get a problem? Okay? Because you put too much small gross margin. Yeah? So gross margin, if you want to have a quite good business, gross margin, you need to care much about gross margin. Yeah. So this is the formula. Okay. That you can use. Yeah. C here is the capital. Yeah. T is the time that you can delay. And T here is the total cost. Yeah. And this is the cash flow needed after receiving the first payment. Yeah. So the rest of the slide is talking about how I derive this one. Okay, using a differential equation and so on. So, and then the final formula is this one. Or this one. Okay. So using this formula, you can get the price based on capital. Okay, you can get the price based on capital. So if you know the capital, then you will know the price. And of course, there is time delay. Okay. So with that, you can compare, okay, what will happen if you have certain fixed costs and you have certain capital and you can handle certain months of delay and certain number of items. Okay, how much is your selling price? Okay, and what is the actual capital needed, minimum for that? So you can use the same formula to compute all of this. Yeah, these are the minimum capital and this is the price. Okay, and this is the number of items that you need to sell at PEP. Again, this is talking about PEP. Okay, and I connect this with the gross margin, the PEP gross margin. So this is the capital. If you know the PEP gross margin, this is the same as the fixed cost time, the delay that you have. And this is the formula that we can use. Okay. And what happened is based on this, you can now compare. Yeah. You can now compare what happened if yeah, this is just the same as before. It's just plug in numbers. Okay. Now, what happened if you actually have this one? Yeah, small trader and big trader. Yeah, of course, small trader have only small capital, but big trader have bigger capital. Okay, and they buy from the same factory. Okay, and of course, small trader have smaller overhead costs, like the fixed cost. Okay, and say the delay is the same. Okay? How much is the price need to change so that they can compete, yeah? And so on. Then you will start to see, yeah, that the small trader need to sell at this point, yeah, items per month, and this is the revenue. And large trader need to sell at much cheaper. Wow, you will see the price here is $4. Yeah, small. trader, and for the large trader, they can sell at 1.5, 1.4 only. Yeah, so this is the comparison. Yeah, at the same assumption here. So this is the actual thing that comes down. This is the invariant for both traders. Yeah. So this is just to show, okay, why people can become distributor. Yeah, distributor can sell at smaller price because they have bigger capital. And this is the formula. But at the same time, they need to sell a lot, otherwise they are lost. Okay. So with this, I hope you can learn, continue to learn. Okay. At least I give you the basic, yeah, of this financial aspect and investment. Of course, you can apply this to your project and on your life. And that's all for today. And thank you very much for the semester.
Is there a question?
Yes, cool.
Will we still be able to have access to Moodle or Revoledo
Yes.
after?
Yes. You can download, you can have access one semester,
Mhm.
right? Because in the next semester, when the new student come in, I need to delete everything,
Mm.
right?
So we download before you delete it.
Yeah. So you have like 5 months
Okay, sir.
download. I think that's more than enough.
Okay, sir.
Thank you, sir.
Yes, but anytime you need to ask, so go ahead, you can ask. You have my number, so yeah. Even if you are not in the class anymore, no problem. Okay. So I hope you enjoy this class. I know this is a lot of materials. Okay. You need to chew slowly after this. Okay. The final exam is on the 30th. Okay, so I open from morning until evening, so you can choose your own time. In 3 hours, you need to finish the exam. Okay, and then after the exams, of course, your group project, you need to finish everything, and maybe within 1 week, okay, I will compute everything, and then I will post in Moodle the Excel file of the computation. You have 2 days to protest to me. If I make mistake, of course, human make mistake, yeah. But if I make mistake, I will fix it. If I don't make mistake, then please accept whatever it is. Okay. So then once you have no more protest, then I will put in the system of YouTube.
I know.
Okay.
Some of the assignments, especially mine, are not yet graded or you
Yes,
already
I
have
am
it.
deliberately not creating it
All right, okay.
to
Okay.
make you feel a pressure for your group project. Otherwise, if I create everything, you will not have pressure in that site.
All right.
And
All right. Thank you very much.
yeah, sorry. This is a strategy to give certain pressure. Okay. What else? Don't worry. Before the 1 week after the final exam, okay, I will create everything. Don't worry about that. Okay, and then I will give you a chance to protest. Okay, 2 days to protest. Okay, so what else? And thank you very much. So you can ask any question anytime. So please do the final exam correctly. Yeah, it's not so easy. Even though this is multiple choice, you have a lot of time, you can open everything. It's not so easy, of course. So study well. Yeah. So thank you very much for the semester.
Thank
So,
you, Doc Cardi.
see you
Thank you very much.
next
Yes,
time.
God bless. Yes.
Thank you,
Best.
sir.
Thank you, sir.
Thank you, Doc.
Thank you, sir.
Bye.
Thank you,
Thank
sir.
you, Doc
Yeah,
Hardy.
thank you. Interesting.
The meat of the
Oh.
discussion.
Right. That's
But
why.
I don't think everyone has taken plan 253.
Okay. So
because
I don't want to put too much here because
yes, sir. So this
other
one, the
courses-
undiscounted one.
Yes. So
But still,
without
it's higher.
discounting, yes. Then what we get? How much?
It's even higher.
Oh yes. Yeah. So the one
But
in
on the slide, sir, it's at 6 and 19. That's why I'm a bit lost here.
yeah, this is not correct. The 22 and 40 is not correct.
This one, sir, the 22 and 40.
Yes. It's too high.
Okay.
Because only two numbers. Right.
And then based on that one, we can do the scenario analysis.
That's
As you-
my analysis.
Yeah, it's just the what if analysis. Basically the same as the data table.
Different.
Because you can do two-dimensional here, sir.
No, you can try this one. You want to try?
I already did, sir. This is
Oh, you
the Excel output. If
Okay.
I'm gonna look at that one.
Right.
Wait. The what if analysis, this is scenario manager.
Right. Scenario.
I
Yeah.
just followed your instruction on the slides.
Right.
So right now, sir, the IRR that I
No,
computed
IR is
in
not
dollar,
correct. Yeah.
sir, is still not
Yes.
correct.
Oh, which one? The
The
6
the
and
22.
19 is probably correct, right?
This one, sir.
That's
Getting
from the-
higher values.
Huh? Higher values.
Yes.
How much is the values there?
Here, this one is the one I computed. 22 and 40.
Oh, even higher values.
Yes.
Okay, so that's probably the one that if you compute it from the computation, I think this is the correct one, right? But why only 3 years? Is that 3 years actually?
Because it is set at
Oh,
3
okay, 3 years.
years
Yeah, okay, 3 years.
for the minivan usage.
Yes, okay, so 3 years and 5 years. So higher value. Yeah, okay. So
Yes,
this
sir.
22 and 40, so you can use that. So 40%. So in that case, I will choose minibus.
Mhm.
And
What I find interesting actually, sir, is this one. You do the annuity for the salvage value instead of putting it on the last year.
I forgot this part. So
Yeah, it's a PMT instead of yeah, it's an annual value.
because
of the salvage.
you assume, right?
Yes, sir.
At the end, right?
Mhm. Instead of putting it on the end, we take the equivalent annual worth.
Okay. So the equivalent you can put it in the present value or in the future value or in the annuity.
Yes, sir. Yes, sir.
So it's up to you to make it. But if we put it in the annuity, that means we want to compare everything in the annuity also, right?
Annual worth. Yes, sir.
Yes, in the annual work also. Yeah.
It makes easier in computing the present worth without using the
Yes.
this one, the cash flow.
Yes.
If you put it in annuity.
Yes. So you can select which one you want.
Yes.
Either in present value. Anyway, the result is the same.
Mhm.
Yeah. So, but maybe the way to compute is more complex.
Yes, sir.
The common one is to put in year zero, right?
Yes, that's the NPV.
Yeah, but not necessary. Yeah, you can choose any.
Yes, sir.
In the present value or year zero, or in the future value, or in the annuity. Okay, good. Yeah, this slide is not correct.
Okay, sir. I'll note that one. So
Yeah.
you'll upload also, sir, this Excel on Moodle.
Which one?
The bus example, sir.
The best example is in the website, I guess.
Okay. So we should download it in Revolut.
Mhm.
Okay.
Yeah. But again, still wrong. Yeah. So
Okay, sir.
yes.
Thank you for that one. And
Yes.
then for the just to clarify on the assignment, we should submit it on or before the 20.
I just changed that to 22 and 23.
Okay. All deliverables, sir. Assignment and group project.
Yes, yes, yes.
Okay. Then no more
No more
presentation.
presentations. This is the last class. So
Okay.
no more meetings.
I missed the first part of the class actually.
If you miss the first class, the recording is always there. So you don't need to worry.
Yes, sir. Yes, sir.
So
Thank you, sir.
thank you. Thank you very much. If you can give me feedback, what can I improve? You tell me. I can improve for next, not for you, but for the next.
For the next one. Basically, sir, the pacing. We did longer for IFN more than the other
Okay,
topics for this class.
right.
So I'm assuming, sir, if we put 252, which is the modeling class, as a core requisite or a prerequisite to this course, we might just skip few meetings for IFN and then have more meetings on the other topics.
My point is some students are not prerequisite in this. They are
Yes, sir. Yes, sir.
number one.
That's
Number
it.
two, education become more standardized. Okay, so but I think there is a problem if we make it into standard, meaning everyone will have the same course, different university, different lecture, and so on. And then, yes, you need to have the certain standard. I agree with that. Okay, but at the same time, we need to go beyond the standard. This is my thinking. Yeah, because if you just the standard, then you have no competitive advantage. Why you are entering UP, for example? Why you not enter other courses, right? So that is no competitive advantage. So that's why every lecturer is supposed to give their own research, right? On top of the standard.
Yes, sir.
Yeah. In this case, the pace become very imbalanced.
Yeah.
I understand that.
For some students, sir, what do you call this?
Struggling.
Might become info overload to absorb in that pacing.
Yeah.
But for us that who took 252 before
No
or
problem.
253 for that matter for the financial analysis, yeah, we can absorb the things you introduce on class.
Right. But there are students that took this first and then 252.
And then 252. So yeah, I one is a group mate of mine last sem, the Joben, I believe.
Oh yeah, Jovel took the reverse, right? So
Yes, sir. Yes, sir.
that's-
But modeling is what should I call this? Modeling is really needed for this class because this one is the analysis part. So you do the modeling first of the data, and then from the results of the model, you do the analysis for decision making. So that's how I appreciate it, and that's why maybe the course number is higher.
okay.
252 and 258.
So let us see if the department or the school is willing to do that. I'm not sure.
Yes, sir.
With my requisition. Yeah. But right now I think it's in par.
Yeah, but for those who are taking the class sole as it is, which is Plan 258, sir. Yeah, it's a bit comprehensive. You might not actually need to take 252 and 253 separately.
Exactly.
If you take the course.
So in my view,
Mm.
this 258 is a kind of optimization analysis,
Mm.
right? And then the 252 is mostly on transport modeling. So that's why go to the network analysis, go to the more
Yes.
more on the transport part. Here is like everyone everyone can take this one.
Mm.
This is what my understanding, but I don't know.
Another thing I appreciate with the how you handle the class, sir, is you let us appreciate first before you do the math. Instead of
I'm trying to motivate, but I
yes.
don't know is that enough or not.
It depends actually on the student.
Mm.
Yeah. Basically we're working students in graduate school, sir.
Hmm.
We're not full-time. Most of us are not full-time students.
Yes. So in my understanding, with the era of internet and AI, everything that you learn, you can learn from AI and cognitive knowledge. Yeah? You can learn from AI or from the material that you have. So then the role of the lecturer or the professor supposed to be motivating, guiding
Yeah.
you to learn by yourself further,
Hmm.
and then distributing our own research so that you have a certain competitive advantage.
Yes,
That's
sir. A lot of the techniques here are
you
not
cannot
very
find in AI.
common.
You
Yes,
cannot
sir.
find in AI. That's the point there, right?
They're not very common in the consultancy industry.
Uh, example, IFN transport, you are expert on that already, right? So once you use, so you can use in consultation if you want.
Yeah, sir.
In fact, you don't really need, what do you call that? Data that much using the IFN transport, isn't it?
Yes, sir. We really appreciated that one in 252.
Oh.
It's just the
Oh.
network structure, then you get
Then,
all
yes.
the metrics.
Otherwise, you need all the data. Yes, you still need flow data,
Yeah,
but
for
all the data
calibration.
is very expensive. And if you like research, so you can also continue that part. So there are many open problems in IFN, and this will become open research for you. So that
Yes, sir.
you start to think if you want to take. Yeah. So probably I cannot advise because I'm an external. Okay, but other I can advise externally. That's also
Yeah.
fine.
Yes, sir. For UP SURP, sir, are you just teaching 252 and 258?
Right now, yes. On because
Do you plan to have a special topic subject like a plan 259?
I don't know. Depends on the team
Yes,
if
sir. I think plan 259 is since it's a special topic, it does not follow a certain title. You can offer anything in plan 259.
259.
Yes, sir. Once I take or I have a seat, I sat in a sustainable mobility class. Another is a GIS class.
Oh, okay.
But both are 259.
So I'm not sure. Let me discuss with the team or the OGS.
Yes, sir. If it's a semester that can be dedicated for IFN as a 259,
I'll be very delighted if I can.
yeah, maybe some students will
Yeah,
be great and provide more feedback on that application.
right. So if we can have a special class only dedicated on IFN, I think this is enough for one semester.
Yeah, yes.
More than enough.
Yeah, you may discuss it with the university, sir.
Yes. You can propose to OGS.
Yes, sir. Yes, sir. I think I'll bring it up with the graduate studies.
Right.
They are asking on they having this course survey, sir.
Yes.
So just one more thing, sir, on the grading you mentioned last when Archie asked. You haven't graded decision under risk up to the present assignment.
If you look at the
Yes, sir.
the one that I still open
Yes, sir.
with all the description, I know that this one did not grading yet.
Okay.
So I mark it.
Mhm.
Okay.
I know. I'm
The one that
corrected,
I
sir.
marked as with the description still there. That one I did not.
Yes, sir.
If I already marked, I will close that description.
Okay.
Okay. I
Okay,
know.
sir.
Thank you very much.
Okay. Thank you very much, sir. If our group will be finished with the work before the submission, sir, we might ask for a consultation first before we submit the
No
grades.
problem. Anytime. Yeah.
Okay. Thank you, sir.
Please email or text me.
Okay, okay. We'll
Yes.
ask my group mates, sir.
Yes. Thank you.
Thank you, sir, for the semester. Again,
For the semester, yeah.
a jump pack full of knowledge.
Yes. I recommend you, especially. Last time, Ateneo want to have a consultation on their traffic system. So, did they contact you?
Not yet, sir.
Not yet. Because I explained, they asked, is there anyone who can do IFN transport in the Philippines? Because I'm not in the Philippines. So I said, I think Arfin can do.
Wow, sir. I'm
Yes.
flattered.
Okay.
Uh,
So,
but yeah, as you remember, sir, last semester I did
because you did,
I
saw.
did that
I
in
saw.
my work.
Yes,
Sing a
exactly.
flyover.
Exactly. So then I said, so if someone want to do it, so please contact you directly.
Okay, sir. If someone would contact me, I'll look at it, sir.
Yes. Thank you.
Thank you, sir. Thank you, sir. I'll just submit the recitation then.
Yes, yes.
Go for the night. Thank you, sir.
Okay, bye-bye. Thank you.